Hello and welcome to our end of May update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just a few adjustments each year to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to this concept of the book, or those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month's video, we're going to introduce something new, the Busy Doctor's Update of the Month. And then we're going to go through the topic of the month, review our systems, starting with the 20-month moving average system, then the MRI system, then remind us about the rules for 25% stop loss system, and then remind ourselves about Sector Surfer. So let's start with this new installment that I'm introducing to our videos. Some of you have noticed that this month's video is a couple of days late. Horrors. And I'm very flattered that people have actually called me to ask me if everything was okay. And yes, things are okay. Couple of things. Remember that the end of month videos usually fall on a Friday, Saturday, or Sunday, in which case I basically get the whole weekend to do a video. But sometimes when the month ends in the middle of the week, like this month, life can get pretty hectic, and sometimes I've been able to do a video in the middle of the week. However, even though I semi-retired 4 years ago, life continues to be busy. I still do part-time work at the local university hospital, at the local VA hospital, and I'm investing for clients and making these videos for you. But the good news is, despite the busyness, I can still easily place the trades as they are indicated. They literally take minutes to see and execute, unlike these videos, which takes a little bit of planning. So yes, being a busy doctor is a mindset. Some of us feel like we're kind of forced into a busy lifestyle with calls and everything. And some of us, for instance, people like Warren Buffett, who are 90 years old and still put in 12, 14-day hours, just love what they're doing. It's a calling. But then, life always happens. And that's why I try to push for people to invest earlier rather than later, because it's very easy to just get a bit caught up with life. Like, for instance, last month, I was helping my parents move from New Jersey to California. So that means flying over New Jersey, help figure out how to pack and deal with a lot of stuff that's been building up for the last 40 years. I have another whole perspective now on estate planning and general life planning. And then trying to plan and coordinate with movers and selling off items such as cars before taking off for good. It was a bittersweet journey. I mean, this is a house that basically lived in since I was 5, and now it's going to be bought by someone else who's going to be tearing it down and building another McMansion. Bittersweet. But I figure, we've had a lot of good memories there. My parents did a really good job of raising us with the limited resources that they had, and now it's time for someone else to build new memories there. And as for this month, things just continue to be busy. For instance, in our local state hospital, the chief of nuclear medicine just found his dream job down in Texas, so he's moving down there. So, by the way, any of you who happen to be nuclear physicians, and preferably double-boarded radiologists, nuclear physicians, if you want to look for a job as a chief of nuclear medicine, come on over to University of Illinois, Chicago. We're looking for someone. So anyway, this guy's gone. So they're asking me to work more because, there's only 2 other nuclear physicians who can cover the department. The whole reason why they wanted to hire me before. And yes, now that I'm working there, I do have this sense of obligation that, it's a department that needs to be covered. And for the first time in years, I've been working 5 days a week. Now is a busy commute of around 1.5 hours, and life can be tough. With evening and weekend calls, it can get busy again, just like how it used to be for me when I was in private practice. So, but despite all that, I've still been able to place trades as they come up, and this is what I'm trying to teach you. So let's talk about the topic of the month. What is a fiduciary? I've had several people ask me about this. In fact, This topic has come up several times. For instance, Tony Robbins in his first book, and then especially in his second book that just came out, was talking about how fiduciaries are financial advisors who hold clients' interests to a higher standard, in fact higher than their own best interest. And you hear about in the news about their Department of Labor laws trying to say that everyone who is managing retirement accounts should be a fiduciary, and how maybe 90% of the financial advisors out there are not fiduciaries. Well, what exactly is a fiduciary? Well, if you take a look at law.com, there's this really long definition, and you can always pause the video and read this, or go directly to law.com and read this. But let me highlight a few things that are of particular interest to us, especially in the investment field. So, for instance, fiduciaries are held to a higher standard of conduct and trust, particularly must avoid self-dealing or conflicts of interest, and always work for the person who trusts the fiduciary. It's a legal standard. If a fiduciary does not hold up to these standards, then clients have legal recourse against the fiduciary. This is one reason why being a fiduciary is not very popular even among money managers. So, for example, a stockbroker or financial advisor must consider best investment for a client and not buy or sell on the basis of what brings him or her the highest commission. Well, this sounds well and good. So, typically, a fiduciary sells advice only and charges only a flat fee, or fee based on assets under management, or some kind of pure fee arrangement like that. In other words, fiduciaries do not sell products with commissions. And one way you can tell whether or not your fiduciary or your investment advisor really is working in your best interest is you can ask them if they are associated with any broker-dealers. Broker-dealers are institutions that actually sell products that give them high commissions. So I'm not going to name names, but if you go to a broker-dealer that sells their own brand name mutual funds, for instance, it may have higher commissions than something with famously low funds, such as Vanguard. And so if you read the statistics, very few advisors are advice only. Part of it is because there is a legal responsibility of being a fiduciary. In other words, they're trying to, instead of selling you something that's only suitable, in other words, something that is good for you at the time of sale, a fiduciary must make sure that not only is it good for you at the time of sale, but also if circumstances change in your life, we're supposed to change what's going on in your finances and in your investments. And typically there are estimated about 7 to 10% of all investment advisors out there who really are fiduciaries. So another question you can ask, if they kind of hem and haw around the whole broker-dealer question, is, well, what kind of license do you have? What kind of securities license? In other words, if you have a Series 65, that is an advice-only license. If you have a Series 7, then legally you are representing the broker. Now, some people can have both a 65 and a 7, in which case, is there a conflict of interest there? Well, we'll explore that in a little while. And then, of course, you have some of these investment advisors who sell insurance products, in which case they have completely different licenses, such as a Series 6 and Series 63. So most investment advisors are dual registered. Why is this? I mean, isn't there some kind of inherent conflict of interest? Doesn't that mean that these dual registered investment advisors are actually dual registered crooks, acting as wolves in sheep's clothing, acting as a Series 7 salesman in Series 65 clothing? Well, let's first disclaim I am a fee-only advisor. I do not sell commission-based products. I do have insurance license, but I do not sell insurance. I'm not defending dual registered advisors. I've just been researching this particular topic at a very intense personal interest. Just because there is such a confusion about this topic out in the real world and even among the financial advisors. So, it's true that there are investment advisors who will sell you high commission or high fee-based house funds or other house product based on their associate broker-dealer. These products may not necessarily be better than any other comparable products out there, particularly, for instance, if a house product S&P 500 index fund, which may charge 1.5%, is not as good as a Vanguard S&P 500 index fund, which only charges 0.3%. So there are also investment advisors who will sell insurance products such as life insurance and annuities. Now, by definition, these products pay commission to the agent, among other costs and fees. I mean, there's just no way of buying life insurance or annuities without someone getting some kind of commission. Now, if there was a way to do it without commissions, that would be great. But, there's a lot of work trying to underwrite someone based on their health conditions and everything, that there is more work into setting up a client with life insurance products. And as an aside, insurance products are not the same as investment products and should not be evaluated the same way. What gets me is that there are some investment advisors who only invest in the stock market or bond market, and they poo-poo insurance products, particularly annuities, and say, oh, annuities are horrible. And yet at the same time, you have some investment advisors who just do nothing but life insurance products. And they say, well, stocks are so risky. Why risk stocks? And, you have arguments both ways, and they have data both sides to support their positions. But the truth is, all of these products have different characteristics. They're not comparable to each other. They're apples and oranges. Each is a tool that can serve specific purposes depending on how we want to scope our financial profile. So just as there are preferable funds and bad funds, I'm using preferable and bad as euphemisms. Similarly, there are also preferable insurance products and bad insurance products. And then, if you take a step back, there are also effective plans and bad plans. You can have the best funds in a bad plan, and that's still not going to serve you. So, for instance, there's some pundits who say buy term insurance and invest the difference, versus other people who say buy permanent insurance. Well, each of these strategies do have their place depending on individual circumstances. There is no one-size-fits-all strategy. And in fact, a lot of these investment advisors keep telling us, oh yeah, they're tailoring everything to their client, and yet they will give you blanket statements like this. So this is something that also gets my goat. So let's see. No one can argue that certain types of insurance are necessary. And no one can argue that agents who sell insurance get paid by commission. So it's also true that if a salesperson honestly believes that products they're selling truly is in the best interest of the client to own, then it becomes a moral duty of the salesperson to make the sale and leave the client better off for it. Any one of you who owns your own business, or any one of you who has anything to do with sales, you know this to be true. Unfortunately, it's also true that many salespeople and agents believe that their products to be in the client's best interest to purchase. And sometimes they really do believe this because they really did do their own research, and some just follow along with the house training to sell their products. But there are salespeople who really believe that whatever it is that they're selling to you is in your best interest. So in which case, a third-party evaluator might, just might have a more objective view of which products might benefit the client, if at all. So this is the basis of why I run my advisory service this way. So the analogy is, as physicians, if a patient visits her primary care physician, and the primary care physician recommends a cardiology consult or an MRI scan, the primary care physician gets no financial remuneration for that referral. So similarly, in my practice, I charge fees only based on assets under management. It's a fee-only, truly fee-only service. And if I detect a need for some commission-based tool, such as insurance, then I will refer the client to someone I trust without financial remuneration. So technically, every model has a conflict of interest. Every practice model has a conflict of interest. So where's the conflict of interest in this referral model that I'm describing? Well, because I can only charge fees based on assets under management, anytime I suggest deploying funds elsewhere that is not under my management, such as paying down debt or buying products from another vendor or hiding cash underneath your mattress. Don't do that. These suggestions are considered conflicts of interest. Even though my take on this is that, well, yeah, it's a conflict of interest, but if it's a conflict of interest favoring the client, I'm actually still putting the client's interest above my own. So now let's review our systems for the month. So we are letting our systems objectively look at footprints of every trader investor in the markets and let the markets tell us what to do. That's why we look at graphs. That's why we look at raw data. We don't look at news. We don't look at interest rates. We don't look at what the latest politician is saying or doing or whatever. There are many indirect pieces of data out there, but the only direct data is the chart data itself. So, for instance, the first system is a pure chart-based system. It's a 20-month simple moving average system, the 20-month SMA system. So the way this works is you take the S&P 500 index fund, which is the top 500 stocks of the United States stock market, and if this index is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. This 20-month moving average is our safety belt. It only works if we watch it every month. So this month, the VFINX, which is the Vanguard S&P 500 index fund, ended at 223.34, and the moving average is at 198.03, which gives us a similar 12.7% cushion. Both the index and the moving average went up last month. So observations for this month. The 20-month moving average continues to signal relative safety in the U.S. stock market. So both the S&P 500 index and the 20-month moving average have increased. Now remember, this system is not designed to catch peaks. In order for this system to generate a sell signal, that means the stock market has to drop 12.7% or more by next month in order for our system to flag danger zone. So here's Sector Server's StormGuard Armor, my counterpart to the 20-month moving average. And if you take a look, this past month, we've been in the S&P 500 index. The white line is the same as the red line. So StormGuard Armor also says it's safe to be in the stock market right now. And here's the indicator saying it's safe. Next system, the Monthly Rotation Investment System, abbreviated to MRI. The rules: every month rank these three different mutual funds: the S&P 500 index, the Emerging Market Index Fund, and the Inverse S&P 500 Index Fund. Rank them, see which one did best, which one did worse, sell the bottom 25% of your portfolio, and use those funds to buy the top fund. So here are the numbers: last month's prices, this month's prices. The S&P 500 index went up 1.4%. The emerging markets went up 1.2%. The inverse fund went down almost 1.4%. Remember, inverse by definition almost does a mirror image of the long fund. And you can see this graphically here on the chart. So under the current model, last month we were 100% in the emerging markets fund. This month we have to sell 25% of our portfolio, so one of these blocks, and buy the S&P 500 index fund. You can use either mutual funds or ETFs. It's still the same model. It doesn't matter if you use Vanguard or Fidelity or any of these other house products that have the S&P 500 index. Although if you want to shop for lower prices, there are lower price funds. And here's Sector Server rotation of the MRI funds. Right now, for the past month, the Sector Server has been in US stocks, not the emerging markets. So remember, whichever model you're following, the Excel spreadsheet model that I showed you before or the Sector Server rotation method, they're both different systems using the same funds. Don't mix them up. So observations of the month here. The US large cap stocks look like they're overtaking the emerging markets, but the difference is only slight. So this is the reason why we rotate only 25% of our portfolio at any one time with the old system based on my book. Sector Server still has not triggered any switch from the S&P 500 index fund. Remember, they use a different algorithm and they switch 100% of the position at any one time. They just do it less frequently. So other systems to monitor: the percent trailing stop system for individual stocks and your own Sector Server strategies. Let's take a look. The 25% trailing stop system. This is what we use when, for some strange reason, you really want to buy an individual stock. You want to limit risk of any one stock to 1% of your total portfolio or your trading account. So you do this by buying up to 4% of your portfolio with that one stock, and then immediately enter a 25% trailing stop loss order. This way, when the stock goes up, the stop loss order also goes up, but when the stock goes down, it will eventually hit that stop loss and sell, limiting your loss to only 1% of your portfolio. If the stock goes up 33%, that means the trailing stop loss is now at break even. Go ahead and buy another 4% of your account's worth of that stock, and then update your trailing stop loss to reflect the increased number of shares. Keep doing that until stopped out. That's it. Next system, remember, if you have your own Sector Server system, if you have a signal, and I had a couple of systems that did signal trades, remember to watch your email or watch your text to make sure you didn't get a signal. And if you're not sure, log on to Sector Server and make sure that you don't have any signals pending. So remember, Sector Server has two main tools. It takes the equivalent of my 20-month moving average, it's called Storm Guard Armor, and tells whether or not it's a relative safe time to be in the stock market or dangerous time. If it's safe, we rotate among which funds we're considering that is the strongest trend among stocks. If it's relatively dangerous to be in stocks, then we look at the relative universe of non-stock funds such as bonds that happen to be doing better at that one time, and then we just rotate between the two. So again, if Sector Server is set up properly, you will get a signal through your email or text. I log in once a week just to make sure I didn't miss any signals. But in general, I haven't missed any signals, at least not for more than a day or so. Now, when you sign up for Sector Server, you will get a free strategy. It's a decent strategy, at least compared to what we are offered through conventional pie chart investing. And in this month, this free strategy remains in the safer stock zone and stayed in the Fidelity Worldwide Fund. So let's take a look. The free strategy is here. It's rotating among these stock funds and going to money market when it's relatively dangerous. So if you take a look at the rotation, the yellow line is what the system has done over the last 29 years. It's returned annualized return of 14.9% so far compared to the stock index fund of 10.4%, making about 5 trades per year. And you can take a look at the safety ratio here. You can take a look at the risk graph here. You can take a look at the drawdown risks here. And you can see how all these other various parameters. The safety score is only 8.3. In general, I like safety scores more than 10. But at least this is free. And we're still in the Worldwide Fund. Watch whatever other portfolio you have. So in summary, remember, these are all different systems. Don't mix them up or mix them together. Remember that Sector Server is a conglomeration of a couple of my systems with a slightly more sophisticated algorithm. Watch for signals and watch for nuances when you're constructing your strategies. We went over the 20-month moving average system, the monthly rotation investment system, dealing with stock tips, and to remind you to monitor your Sector Server strategies. So keep those questions coming. I know I talk to several of you personally every month. But for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague. Here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me, set up a consult. A few of you who I've talked to, you know your stuff. You're fine. I don't have to worry about you. But for some of you, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely